Welcome to this next lesson. We're going to be talking about the special handling required for IRA distributions for traditional IRAs. The original contributions made to an IRA while a Massachusetts resident are not taxable by Massachusetts when taken later on as a distribution. Now, they are still taxable federally. Now, this is not applicable if the IRA is from a rollover of a deferred compensation plan like a 401k, as those contributions have never been taxed by Massachusetts. Also, if the taxpayer made the contributions while a resident of another state, then all distributions, including original contributions, are taxable by Massachusetts. Again, for the same reason, Massachusetts had never taxed those original contributions. Now, why the special handling? Note the 1040 line item below. The federal government provides a tax deduction for contributions to a traditional IRA. Therefore, that money has not been taxed federally until withdrawn through a distribution. However, Massachusetts provides no such deduction. Therefore, the original contributions made to an IRA have already been taxed by Massachusetts, so are not taxable again when withdrawn as a distribution. Let's look at how this works. A taxpayer makes contributions to a traditional IRA, generally over a number of years. Also, depending on how the IRA is invested, there are gains, either capital gains, interest, dividends, or a combination of all three. Remember, Massachusetts has already taxed the contributions, the money in green, but has never taxed the gains, the money in red. Now, the taxpayer starts taking distributions. They are not taxable until all of the original contributions have been withdrawn. Only when the taxpayer has started to withdraw gains are those taxable to Massachusetts. Now, the taxpayer is responsible for providing the total contributions and the total prior year distributions. If there are no accurate records, then have the taxpayer arrive at a reasonable and defensible figure. Please include that in the taxpayer's paperwork for use in subsequent years. Let's look at an example. Mark Austin received an IRA distribution of $268 this year on a 1099-R with the IRA box checked. He tells you he had a contribution of $12,000 over the years. He was a Massachusetts resident at the time that he was making those contributions. In previous years, he had taken a total of $1,350 since he started taking distributions. Let's look at tax layer and how we would handle this. Okay, let's open up the Massachusetts return for Mark Austin. And we're going to go to additions to income. We'll scroll down, and where it says taxable IRA worksheets, we're going to click begin. Now, in this first box, total contributions taxed previously by Massachusetts, that's what he contributed while he was a Massachusetts resident. We're going to put in the $12,000. The next box, total contributions received in previous years, that's the $1,350. It doesn't include what he received this year. It's just the past years. And we're going to leave that last box blank. We'll click Save, and then Save here. And you'll see that his mass refund has increased because now his IRA has been marked as not taxable to Massachusetts. It's still taxable for federal, but Massachusetts will not. We'll exit out, and we're done. Now, you do want to note for next tax year that his prior distribution is now $1,618. That's the $1,350 from prior tax years plus the $268 from this year. Do note it on the paperwork so that the counselor next year will have that total handy. Now there's one more area that we do want to cover, and that's a special case of married filing jointly and both spouses made traditional IRA contributions while a Massachusetts resident and both taking distributions this year. There's a worksheet that you can find on the Massachusetts TaxAid.org website that can help you with these calculations. Include the worksheet with the taxpayer's paperwork for next year. You'll need the same information for both taxpayer and spouse. In this example, the taxpayer had contributed $10,000 to their IRA while a Massachusetts resident. Previously, they received distributions of $9,000. And then this year, they had received distributions of $2,000. In the case of the spouse had contributed $8,000, again, while a Massachusetts resident. Total distributions received in previous years was 0, which means this is the first year that the spouse had taken distributions. The spouse received a distribution of $1,000. We sum up the total distributions by both the taxpayer and the spouse, $2,000 plus $1,000, and we get $3,000. Now we're going to have to look at what of that $3,000 is taxable. In the case of the taxpayer, of that $2,000, they had $1,000 which has not yet been distributed of money that they had previously been taxed by Massachusetts. So I'm basically subtracting line 1 from line 2, 10,000 minus 9,000, and I'm going to get $1,000. In the case of the spouse, it's $8,000 minus 0, or $8,000. So basically they have the whole contribution that's previously been taxed that's been available. Now we're going to calculate what the total of their 2018 distributions are taxable. We're going to take line 3, subtract line 4, but it's going to be not less than 0. So in the case of the taxpayer, we take a distribution of $2,000, we subtract the $1,000, which is the remaining contribution that had previously been taxed, we get $1,000 remaining. In the case of the spouse, we have $1,000 that was the distribution for this year. They have $8,000 remaining, and so that's less than 0, and so we're just going to use 0. You can't put a negative number here. So total taxable distribution, $1,000 for the taxpayer, 0 for the spouse. So it's a total of $1,000 for the couple. So since the couple received $3,000 of distributions this year, only $1,000 of it is taxable. We need to make an adjustment in tax layer of $2,000. That's the $3,000 minus the $1,000. Now let's look at how we're going to make that adjustment in tax layer. You'll remember from the Mark Austin example, we went into the worksheet identified here. However, if you'll recall, there was only a box for a taxpayer. There was no room to put both taxpayer and spouse in that worksheet. And so we had to calculate it independent of tax layer. That's why we used the previous worksheet. So now that we've calculated the $2,000 adjustment we have to make, we're going to enter it in this box right here. So it's right below the blue comment to adjust Form 1, line 9. We're going to enter it as a negative number because we're basically asking tax layer to reduce the taxable IRA amount from $3,000 to $1,000. So we're saying subtract $2,000, and that will help get the correct taxable amount of $1,000 of taxable IRA distribution. So that's all there is to that adjustment. It's relatively uncommon, but if it does happen, you want to be able to accurately adjust the amount for a married filing jointly we're both made contributions while residents of Massachusetts and both getting distributions this tax year. Okay, hope that helps explain the area of special handling for Massachusetts taxable IRA distributions. Please contact us if you have any questions or comments. Thank you.